Sean Fenton. He's portfolio manager at Tribeca Investments. He oversees more than $1 billion in assets. Sean, Happy New Year to you. Thank you for joining us on the program here. Let's begin with the Australian markets. We are seeing some upside today on the back of that manufacturing figure. Are you as optimistic as investors seem to be starting out 2012?
It's always good to start a new year with a bit of optimism. So I think it is important if we can see some stability in China, and that manufacturing indicator is a good lead. We've seen it already in the US, where manufacturing is starting to rebound, and even some signs of bottoming in activity in Europe. So I think that's very important. Markets have really factored in some pretty dire scenarios for next year, with potential Eurozone breakups and deep recession. So just getting some stability there and some stabilisation in growth in China I think is very important and a very positive lead for the new year.
Certainly we need to take this with a dose of reality, because the European debt crisis is still very real and concerns about China's economy still there. So what scenarios are you looking at, and what potential risks exist this year for the Australian economy and those markets?
Yeah, it's a very tricky question, because there's certainly a lot of risk out there, as you've highlighted, and Australia's not immune from that. We've seen activity continue to slow under higher interest rates and a higher dollar, and that looks like it's continuing in the short term, with pretty weak retail spending, construction activity pretty weak. It's really just the mining, services and construction sectors that have been holding up the economy. So a little bit of weakness there, but certainly big tail risks out there. If see further stress for the European banking system flowing through to world markets, Australian banks are pretty vulnerable to that. They do have big offshore funding requirements, and that could further constrain credit and growth in Australia. And also China, we're obviously very leveraged into China through commodity and resources. Bulk commodity prices have already been easing, with iron ore and coal coming back. Energy prices holding up a little bit better, but they all present downside risks to the Australian market. Balancing that out, though, that is so well expected in the market, and valuations really have been crunched down in a lot of those resources and global cyclical sectors to reflect those risks. So I think where we're positioned now, with just some more positive news starting to come through, the risk-reward trade-off's actually starting to favour being a little bit more aggressive and looking for, if not a bottom in the market, certainly a bear market rally coming into the first half of the year.
Let's talk about the resource sector. Obviously, China, as you said, has a heavy impact, we should say, on those Aussie miners. Are you recommending shorting any of the miners, given the constraints that you just pointed out?
Yeah, look, I'm reasonably cautious on the bulk commodities, particularly with ongoing constraints on property investment in China. So the more steel-intensive sectors, with which are fed by iron ore and coal, it's very difficult at the moment. Even with China looking like it's not having a hard landing, maybe something a bit more softer, it's hard to see the real strength and demand there that's going to pull bulk commodity prices higher and get the sort of hot money flowing back into those sectors. So we're positioning ourselves for weaker global growth in general, and underweight some of those bulk commodity sectors, stocks like BHP, Rio and Fortescue. We are a bit more positive on the energy space, though. The oil market continues to remain pretty tight, and even if China moves away from fixed asset investment and has a smaller focus on construction and steel intensity going forward, we do see ongoing growth there, a soft landing, and ongoing demand for energy, which is very highly related to GDP. And also with the US economy looking like it's doing a fair bit better, they're quite energy intensive in their growth as well. So we're a bit more optimistic on sectors such as oil and gas, and even copper, if you get US housing start to recover in any material way.
And Sean, with the time we have left here, how do you expect the Reserve Bank of Australia to move on interest rate policy? They've got another meeting coming up in February. What kind of move do you expect them to make?
I think we'll see another couple of interest rate cuts through the year, reflecting the weakening growth momentum that we have at the moment. The Reserve Bank's increasingly recognising some of the tail risks that are out there, and in particular the fact that Chinese growth has been slowing a bit more than expected, and also our terms of trade is weakening. So I think they're factors that the Reserve Bank will take into account, as well as a pretty sluggish pace of growth domestically, recognising that the household sector is still very highly geared, with a fair bit of mortgage debt there, and high interest rates by world standards is causing a degree of constraint and spending there, and the high Aussie dollar is really dampening activity in our export-exposed sectors as well. So do expect to see a further couple of interest rate cuts, and the Aussie dollar probably weaken through the year as well.
Sean, we'll have to leave it there. Sean Fenton of Tribeca Investment Partners, thank you for your time this morning.